Welcome to the Opening Bell Report.
Okay, let's just dive right in. The elephant in the room. It is Saturday, January 17th, 2026.
Yep.
And if you've so much as glanced at a brokerage app or, honestly, Twitter in the last couple of days, you know what we're talking about today.
You can't miss it. It's the big red N.
It's absolutely dominating the conversation this weekend.
It really is.
And the tension is, you can feel it. We're looking at Netflix, ticker NFLX, sitting at about $88 a share.
A level we really haven't seen since the split adjustment.
Exactly. And the sentiment, especially from, the retail crowd, it just looks like pure panic. It feels like a stampede for the exits.
It does look like a fire sale on the surface. But that disconnect, that gap between the panic you're seeing online and what the actual data is telling us, well, that's why we're here.
Right. And that's the mission for this deep dive. We've got a stack of analysis reports all focused on this setup going into earnings on Tuesday. We need to figure out why, despite this price drop, the big institutional analysts are basically screaming, buy.
Exactly. It's a classic conflict.
Sure.
You have market psychology on one side, which is all fear right now.
Totally fear-driven.
And on the other, you have the fundamental reality of the company. And when those two things get this far apart, that's usually where the opportunity is.
So the big question for everyone listening is, are we looking at a falling knife here? Or is this some kind of golden ticket disguised as a train wreck?
That is the multi-billion-dollar question, isn't it? The analysis we're looking at strongly suggests this might be a contrarian setup.
A contrarian setup.
The core argument is that this pullback to $88 isn't a warning sign. It might actually be a gift.
A gift. I have to be honest, $88 feels less like a gift and more like a lump of coal if you bought in higher. But let's dig in. We are on a deadline here.
We are. Earnings drop this coming Tuesday, January 20th.
After the bell.
After the market closes. That's the catalyst. Everything we're seeing right now, it all revolves around that moment.
Okay, so let's start with the setup. Fear versus opportunity. You said the price is $88.
$88 flat as of Friday's close.
And looking at the charts in this report, that is just scraping the bottom of the barrel.
It is. We are right at the low end of the 52-week range. The analysis identifies $82 as the hard floor.
The floor, okay.
So we're hovering just $6 above that. If it breaks 82, that's a problem. But for now, it's holding.
Which usually terrifies people, right? Standing on a ledge. But the analysis makes this really interesting point about a narrative flip.
Right.
It says stocks typically run up into earnings. They get more expensive because everyone wants in before the good news.
That's the standard playbook. Buy the rumor, Investors expect good numbers, so they bid the price up. But Netflix
has done the complete opposite. It's drifted down. So why is that a good thing? Shouldn't we be worried?
It seems counterintuitive, I know. But think about expectations. The market is all about expectations. If a stock runs up 20% before earnings,
then the report has to be perfect.
Absolutely perfect. Miraculous, even. Just to justify that price. If they miss by a penny, the stock gets crushed. The bar is just too high.
But because Netflix has drifted down?
The bar is on the floor. This is what we call de-risking. The market has essentially priced in bad news already.
So if the report is terrible?
Well, the stock is already down. It's hard to fall off the floor. But, and this is the key, if the report is even just decent.
Not amazing, just okay.
Just okay.
Yeah.
The lack of high expectations creates what this report calls a coiled spring effect.
A coiled spring. I like that visual. So the pressure is building downwards and a little bit of good news.
Snap. A potential pop to the upside because all the sellers are exhausted. Everyone who is scared is already out.
That makes perfect sense. And we have to remember the context. You mentioned the $88 price.
Right, it's a double-digit number.
It's easy to forget this is a post-split environment, the 10-for-1 split.
Exactly.
Yes.
So $88 looks psychologically cheap compared to the old $1,000 tech stocks. But this is still a $400 billion company.
$400 billion, it's just a staggering number.
It is. And it's trading at what the analysis calls a psychological discount. The fundamentals of that machine didn't just vanish.
Okay, so price is low, expectations are low, and that might be an advantage. But that's all theory. I want evidence. Let's talk about why the analysts are so bullish.
This is where the divergence gets really, really stark.
Because the retail crowd is not bullish at all.
Not at all. If you're on the message boards, it's all doom and gloom. But the institutional notes from just this past week, overwhelmingly bullish.
It's like they're living in a different reality. Okay, let's name some names. The report lists a few.
Yes, let's get into the data. First up, Wedbush. They came out with an outperform rating.
And their price target.
$115.
Whoa, okay, hang on. From 88, what's the math on that?
It's nearly 30% upside from where we are right now.
30%, that is a massive call. For a fund manager, that's a career-making kind of trade.
It is a significant target.
Yeah.
And they're not alone. TD Cowen also put out a buy rating. Same target.
115. Okay, so it's not just one outlier.
Not at all. And then you have Rosenblatt, also a buy,
Yeah.
with a $105 target. So the consensus range is, well, it's way up from here.
But why? I mean, what are they seeing that everyone else is missing? It can't just be a hunch.
No, it's not a hunch. It's based on two very specific drivers that are finally starting to bear fruit for the company.
Okay, what are they?
First, the ad tier.
Right, the commercials. I remember everyone swore they'd cancel if they saw a single ad.
People said they'd hate it, but the data suggests they're watching. The revenue from that advertising tier is finally rolling in a big way. It's a real income stream now.
And the kicker, according to this, is that the margins are better.
Often, yes. Because with a standard subscription, they get your $15 and that's it. With the ad tier, they get your lower fee, plus they get paid by advertisers for every show you watch. The average revenue per user, the ARPU, can actually be higher.
That is wild. The cheaper plan might make them more money per person.
Eventually. And the second driver is the one everyone loves to hate.
The password crackdown. Don't remind me. I think I'm still mourning my brother-in-law's account.
You and millions of others. But from an investor's point of view, that pain is pure profit.
Because it's working.
It's successfully boosting global subscriber numbers. All those freeloaders are converting into paying customers.
So the big picture here is that Netflix pulled two huge levers, ads and password sharing, and they're both working at the same time.
That's the synthesis, exactly. The company's fundamentals, like revenue and subscribers, aren't getting worse. They're actually improving. Only the stock price has gone down.
And that's the disconnect. The business gets better, the stock gets cheaper.
And that's the disparity the analysts are targeting. They're betting the price eventually has to catch up to the reality of the business. It's like holding a beach ball underwater, sooner or later.
It's going to pop up. Okay, the story sounds good, but I want to look under the hood. Let's do a reality check on the financials. Because when a tech stock drops this much, the first thing people yell is, it's still overvalued.
A very fair concern. Tech valuations can get pretty stretched.
So let's talk PE ratio, price to earnings. The report says Netflix is sitting at roughly 36.
A PE of 36. So you're paying $36 for every $1 of current earnings.
Which, for a traditional value investor, might sound crazy high. The market average is usually, what, 15 or 20?
For the broader market, yes. But you can't compare a high-growth tech company to, say, a bank. Context is everything.
So is 36 expensive for Netflix right now?
The report makes the case that for a company growing revenue at 17% year over year, a PE of 36 is actually pretty reasonable.
17% growth is. That's fast for a company of this size. Usually giants slow down.
And that's what you're paying for, the growth premium. If their growth was flat, 36 would be dangerously expensive. But with that kind of growth, the market is willing to bet the E in PE will catch up to the P.
There's another number here that jumped out at me, the war chest.
Ah, yes. Free cash flow.
It says they're sitting on $2.7 billion.
Billion with a B. And that's the cash left over after paying for everything, including all the content. It's pure cash in the bank.
So what do you do with $2.7 billion?
It gives you incredible strategic capability. The report highlights this. They can do three key things with it.
Okay.
1, create more content. The streaming war is an arms race for hit shows.
True. If there's nothing new, I cancel.
Exactly. 2, they can buy back their own stock. If they think it's cheap at 88, they can use that cash to buy shares, reducing the supply and pushing the price up.
Betting on yourself. I like that.
And 3, they can outlast competitors. When you have that kind of cash, you're not desperate. You can squeeze the smaller players who are bleeding money. It provides a huge safety net.
Okay, so beaten down price, bullish analysts, strong fundamentals, pile of cash. It all sounds great. But it all comes down to Tuesday.
This is where the rubber meets the road. All of this analysis is just theory until Tuesday, January 20th.
After the market closes, so the bell rings and then it's go time.
The report drops and the reaction could be instantaneous. We're talking milliseconds in today's market.
The report lays out a prediction, a specific scenario. What is it?
It's all about guidance. The market cares about last quarter, sure, but it cares way more about what's coming next.
The windshield is bigger than the rearview mirror.
Precisely. If Netflix comes out and announces really strong guidance for 2026, if they say, hey, next year's going to be even better,
we could see a huge move. What kind of numbers are we talking?
The report mentions immediate after-hours targets of $95 or even $100.
That fast? On Tuesday night?
It happens all the time with earnings. If that coiled spring is as tight as we think, and the news is good, that energy gets released in minutes. You could see a $10, $12 jump in a heartbeat.
And what's this about a pre-earnings move? The report says we might not even have to wait until Tuesday.
Right. This is trading psychology. The smart money, the big funds, they don't wait for the news. They anticipate it.
They want to be in their seats before the show starts.
Exactly. If they believe the report is going to be good, they'll start positioning themselves on Monday. They want to buy at 88 not chase it higher at 95.
So we could see buying start to pick up as early as Monday morning?
That's the prediction. As more investors realize, wait a minute, this stock is at $88 right before earnings. That's too cheap. They'll start buying.
And that buying itself pushes the stock up before the news even hits?
Correct. So that gift of an $88 price tag might not be on the table for very long.
It's a fascinating game of chicken. You have the retail crowd selling out of fear and the analysts screaming buy because they see the setup.
And that is always where the biggest opportunities, and let's be honest, the biggest risks are found, in that divergence. When the crowd and the data say opposite things, someone is about to be very wrong.
So let's wrap this up. We've unpacked it all. What's the final verdict from the analysis we've seen?
The summary is really this. You can look at that $88 price with fear.
Yeah.
You see a stock that's breaking down, losing momentum. That's the emotional take.
Or
you can view it through the lens of this analysis as a setup. You have a hard floor at $82 and potential upside to $115. It becomes a risk-reward calculation.
So you're risking about $6 of downside
To potentially capture $27 of upside, it's almost a 5-to-1 ratio.
That's a compelling ratio.
The source's stance is that this is a reversal play. The coil is wound tight.
And the bad news is priced in.
Exactly. The upside is there for the taking if the company delivers on Tuesday.
There's always the if. But hey, if it were guaranteed, it wouldn't be an opportunity. So here is the final thought we want to leave you with. We've laid out the entire bull case. We've talked about the coiled spring. But the central question from this analysis is still on the table. Is Netflix a BUY or a trap at $88?
It forces you to ask yourself,
Mm-hmm.
do you have the conviction to hold through earnings when the crowd is running for the hills?
And that's really the difference, isn't it, between retail panic and institutional strategy. Are you following the noise or are you looking at the data?
The data says opportunity. The crowd is screaming danger.
Tuesday will tell us who's right. It's going to be a wild week. Thanks for diving in with us.
Exact time.
Don't forget to like, share, and subscribe for more.